We're live. What's going on, everyone? Welcome to the next edition of the Venture Coiners podcast. We're going to be looking at institutional capital in crypto assets today, and we're joined by Ari. What's going on?
Hey, Luke. Thanks for having me.
Yeah, I really appreciate you coming on. I know you've been taking a break from podcasts and a lot of content in general, kind of looking to really formulate your next big ideas, I guess you could say. So I do appreciate you coming on. Just for people that maybe don't know you as well, I know most of the people on Twitter and most of the people that are probably deep in this space understand who you are and what you do. Can you break down who you are and what is BlockTower?
Sure. So BlockTower is a crypto investment firm that we launched just under a year ago. It's kind of amazing how fast a year flies in the space. My own background was kind of traditional finance on the trading and investing side. I was an options market maker and FX and commodity trader for a firm called Susquehanna International Group. And then I was a portfolio manager for an endowment, which is kind of long-term investing, risk management, portfolio management. And the idea with BlockTower is we're opportunistic. We invest in crypto in kind of every way you could imagine. As a firm. And Luke, I think we first connected like a little bit less than a year ago. I think like shortly before BlockTower launched. So you were actually, you were one of the earlier kind of crypto Twitter people that I connected with, and I think I'm pretty good at recognizing talent. That was fairly early on as you were kind of gathering, creating the group and name for yourself that you've created. So it's been a pleasure kind of following you and seeing you succeed.
Yeah, it's been fun. I think back then I was actually still a Warren Buffett avatar, still anonymous, and I respect a lot of people that have stayed anonymous in this space. I've chosen to kind of dox myself and still am one of the only ones using my face and real name. But the conference that we actually met, I think it was in September, and it was at the Fund Symposium in San Francisco, and I was still Warren Buffett, and we talked about meeting, and we had a conversation back then. So yeah, it was funny. It leads into kind of exactly what I wanted to talk about. So at that symposium, there was a question posed. I'm not even sure if it was the panel that you were on or it was a different panel. Someone asked, who here either works for a crypto hedge fund or works for a fund, or who is starting a fund? And 90% of the audience, and this was bizarre, this is September last year, 90% of the audience raised their hand. And this wasn't like Consensus Invest. There wasn't thousands of people. It was still a big conference, right? It was overflowing. There was like a few hundred people there, and everyone raised their hand. How, I want to talk about institutional crypto. What's kind of the effects that, how have people came into this space? When are, there's a meme almost of institutions coming into crypto. How much of the space do you think, or how many institutions do you think are in? I want to break down what kind of institutions are in. Is it just VCs? Is it pensions, endowments?
Sure. So a lot of people saw, that's a great anecdote. A lot of people saw Laura Shin, I think it was in maybe August of last year, wrote an article about how like 300 hedge funds launched. And that's a question I got asked a lot. Has it become insanely competitive? Are there tons and tons of funds? And the answer is there really aren't. So of the 300 funds, most were like one or two 24-year-olds in an apartment. They weren't funds in any sense. And I don't mean that to insult them. Some of these are really, really sharp investors or traders that I love trading insights with, but they don't control any meaningful amount of capital. They're not investable from the perspective of an endowment or a pension or a family office. It's very, very hard for any money that's run by a bureaucracy, any money that if you're an individual and you're looking to deploy your capital, all you're worried about is your return and your risk. You're not worried about saving face. You're not worried about keeping a job. You're not worried about looking stupid. The money that's being allocated by a family office, for example, or a VC firm, they have concerns beyond just maximizing return. And so one of the things they have to do is they have to do diligence. If they lose money, they have to make sure that it wasn't from negligence. And so they have to review any fund that they would want to invest in. And if it's a 25-year-old working out of his apartment, that's very, very hard for them to underwrite, even if that person is the world's best investor, even if that person is brilliant. So the reality is in the US, there's only like 15 funds that are funds in any kind of meaningful sense. Mm-hmm. None of them have raised that much money. Some of the funds that are the biggest have generally grown organically. So some of the funds that launched prior to 2017 or early 2017, they produced phenomenal returns, and they didn't have that much capital from investors, but they've grown to be quite large because they earned a 10 or 20x on that capital. So the institutional money that's come in, both directly and via funds, initially it was a lot of kind of Bay Area venture capital firms. So this is totally public. Union Square Venture, Andreessen Horowitz, Sequoia, they were all very early investing in cryptocurrency. They were I believe at least 2 out of those 3 were seed investors in Coinbase. A lot of them were early investors in some of the earliest crypto funds. More recently, they started directly investing in ICOs as well as exchange-listed assets. I think the reason for that was those are firms, they're investors that are used to taking risk. They're used to having some zeros. If you're a pension fund and you invest in basically, if you're a pension, you don't want any investment ever to go to zero. If you're a VC fund, that's your business model. You're used to having some limits, and that's kind of part of the game. So the earliest institutional money was VC. Then it was small family office, where you would have you'd have a wealthy family and you would have one individual running that pool of money. And so there's less of a bureaucracy. If it's one individual making the decision, it's easier for them to pull the trigger on something risky. More recently, it's kind of moved up this ladder of bureaucracy. So then you have larger family offices that will have an investment committee or have a team. Endowments finally started writing checks. So I'm not sure if this is public yet, so I won't name the endowment, but one large endowment wrote a check to one of the large new crypto VC funds. It's a spinoff of one of the giant traditional venture capital firms. So we have seen, and it's kind of worth noting that was a little more palatable for that endowment to write the check, because it was a giant, old, respected venture capital firm run by a gray-haired partner, air quotes gray-haired, someone just with a lot of experience and prestige and credibility among traditional investors. And they raised that fund. They raised $300 million to do early stage crypto investing. So we are seeing institutional money come in, just slowly. The main obstacles are, one element was a lack of credible fund managers, people who, this is very stereotypical. When I say credible, I mean this very much in terms of appearances and optics. It's just a lot easier for an endowment to invest with a 45-year-old who's been running a fund or a partner at a world-class VC fund for 20 years than with a 25-year-old. And so you're seeing...
I don't even want to get too ahead, but I think that's in that exact same panel. I think that's one of the things you mentioned in why you may have left. You worked at Susquehanna, you worked as a PM in the endowment world, and you come from traditional finance. That's one of the reasons you started BlockTower, correct? Correct me if I'm wrong. It was to almost give institutions or those funds more of a route to actually invest in this space. Was that one of the reasons that you started BlockTower in general?
Definitely. Yeah. So when I was at UChicago, I interviewed all the funds I could find at the time on behalf of UChicago, thinking I want UChicago to invest in crypto, and I knew it wouldn't be right away. And what struck me was there weren't many funds in total, and of the ones that were around, even ones that were run by people who I respect, they just weren't investable. And what that means is there was no way the endowment was going to be able to get comfortable investing with a young guy working out of his apartment who's never managed money before, who maybe doesn't know what alpha and beta is, who can't talk the talk, even if that person is a very, very intelligent crypto investor. So we kind of saw, I saw that lack in the market. Over time, what's happening is as crypto is ballooning and gaining attention, you're getting more and more veteran VCs, veteran Wall Street people getting into the game. So that's changing. A big thing is custody. So anyone who, this is changing right now, but for the most part still, anyone running a fund could probably steal their investors' money and get away with it. And so if you're underwriting a fund, you're really trusting the fund manager in a way that you normally don't have to in traditional assets. To do what like Bernie Madoff did is really, really hard. It's not easy to get away with what Bernie Madoff did for so long. Bernie Madoff was the fraudster who just was falsifying accounting for like, I don't know how many, a decade before he was finally caught. It's possible to steal US dollars, a lot of them, but it's hard. Like if someone were to wire $20 million from a bank account into the Cayman Islands or Estonia or wherever, they're probably getting caught because it's easily traceable. If someone steals cryptocurrency and they know what they're doing, they might be able to get away with it. So there's currently a lot of trust involved in investing in a crypto fund or investing. I mean, how can you trustlessly own cryptocurrency? So, most people who own cryptocurrency, they own it on exchange. So they buy Bitcoin on Coinbase, they leave it on Coinbase. Well, Coinbase is not a bank. Coinbase is just a company. You're just a creditor of Coinbase. If Coinbase gets hacked or goes bankrupt, you may or may not ever get your Bitcoin. So, I think the more sophisticated people in the ecosystem know that you can store your own Bitcoin using a hardware wallet. There's a lot of ways to do it. But it's not trivial. It's not that easy for someone to get comfortable with that whole process. And two, it's hard. It's somewhat easy to use a hardware wallet as an individual, but how do you use a hardware wallet as a bureaucracy, as a board, as an investment committee? Who controls that hardware wallet? Who has the private key? So having processes around that is what custodians are trying to solve. There's at least 6 credible custodians that we're kind of looking at right now. They're in the process of launching. So Kingdom Trust is up and running and has been for a little while. Coinbase just went live with their institutional custody solution. There's a handful of others. I'm not sure where various there was a point where I name dropped one of the custodians, and apparently they hadn't like tried to publicly reveal yet, so they weren't upset at me. But I want to be careful about not being ahead of kind of the official PR release of a custodian. But there's a handful of others that are very credible, working hard, and I'm optimistic that they'll be fully up and running. And by fully up and running, what I really mean is, do I trust them with my own money? That's ultimately the standard. It's almost, do I trust them more than I trust myself, which is a very high standard, because even if they're much superior than me from a technological perspective, it's just a lot easier to trust yourself than a team of people, right?
Yep.
But I'm very optimistic that they're solving this problem, and I think that by year end, most fund managers will be using entirely third-party custody, and family offices, pensions will feel comfortable at the margin, at least starting to, custodying Bitcoin or Ether or anything else with these third-party custodians. That is the point at which a pension can think about investing in the space.
Yep. And there's so much to unpackage there. We're going to unpackage it more as we move along. The one thing that I want to start with is kind of the beginning of your response, and in terms of what institutions are in and what's going to kind of be the hurdles for others to get in. You have a blog post on your site about table selection. It's one of the things that I would recommend everyone to check out. I'll link it below. And you talk about poker playing when you were in college, and you didn't play professionally, at least to my knowledge, but you at least understood that if you were to play at an easier table or a softer table, obviously your chances of winning were a lot higher. And you kind of bring that over to investing in terms of asset classes, and you say in cryptocurrency, this might be the softest table, this might be the easiest table. As more institutions get in, that obviously might change. Do you still think that's true? And kind of can you break down that analogy for everyone else?
Sure. Yeah. So first, the high level. So the idea for people who have read the essay is, in poker, the single most important decision you make is which table to sit at, because if you're the 11th best player in the world, but you sit down with the 10 best players, you're going to lose money. And if you're a bad player, but you sit down with the worst players, you'll make money. So when I was in college at Penn, I had a ton of friends who were great poker players, some of whom were definitely better than me, who were constantly broke because they would sit down with basically the 10 best players in the world. And it was a lot of ego that drove that. They wanted, a little bit of it I admire, certainly. The desire to test yourself against the best is a very admirable desire. I myself definitely lost 5 figures to the world's 3 best players very deliberately, thinking I'm willing to pay, I'll take $5,000 and I'll sit down with Phil Ivey, and I know that I'm basically playing basketball against Michael Jordan, and I'm doing it for the experience.
For the lesson almost, yeah, exactly.
It's for the lessons, for the experience. I had some friends though who instead of it being $5,000, it would be $50,000 or $200,000 that they could not afford to lose. It was just kind of very ego. So applying that to financial markets, it's extremely hard to make a living in most financial markets today because it's so incredibly competitive. So you have these multi-billion-dollar pools of capital with the smartest people on the planet, the highest frequency, lowest latency trading, the best machine learning algorithms. You're competing against a firm like Rentech that has 1,000. Rentech is Renaissance Technologies, maybe the best performing hedge fund in history. Yep. And they have a pool of capital that's, I'm throwing out round numbers here, I'm not sure the exact, but something like over $20 billion, 1,000 engineers, hundreds of millions of dollars of sunk cost on optimizing their electrical engineering, their circuit boards, and teams of the world's best machine learning guys. They have the lowest cost of capital, the lowest exchange fees. Everything is optimized, and you're kind of competing against them if you're trying to do anything algorithmic or short term. If you're competing long term, well, then you're competing against people like a Warren Buffett who can get a sweetheart deal, or who have better access to information, or who have. So it's not that you can win. It's it's playing basketball against Michael Jordan. It's a very tough game. Cryptocurrency right now is still 95% retail. It's still mostly people who have no idea what they're doing. And I say very honestly that kind of no one has any idea what we're doing. So I have no idea how to fundamentally value cryptocurrency assets. I try to do so within an order of magnitude. We don't know what kind of token economic, we don't know what works in token economics, but I think we have some idea of what doesn't work. But at least you have a lot of people, I don't want to compete against other people who are professionals. I want to compete against the person who is, who doesn't know what a hard fork is and is buying Bitcoin or selling Bitcoin on a CNBC headline, a Bloomberg story, a rumor. That's not going to change for a while. So at the moment, there's 30 million people around the world who own cryptocurrency. Yes, there's a lot of professional money coming in, and professionals are increasing assets and controlling more money. But you're going to get periodic waves of new retail inflows that will dwarf the professional money. So right now, it's a trader's market. There's not a lot of retail money coming in or out of cryptocurrency. So it's actually a fairly tough market to trade right now, because it's a lot of people all trying the same kind of short-term TA, or all trying to trade on the same basic games. But this is kind of cyclical. So at some point in the next 6 months, there'll be, I think bullish, but maybe it'll be bearish, but you'll have a massive flow of money. You'll have kind of whales. And then as a trader, you can basically trade ahead of the whale, or trade against the whale. I think, in early 2017, we saw this massive influx of South Korean money. So if you could guess that a coin was going to be listed on BitBum, you could buy it and it would go up 100%. Even if you just traded on the headline, you could be ahead of those South Korean retail buyers who are similarly responding to headline 6 hours later. That's going to happen again periodically. This is such a new asset class. It's such a nascent industry that I think we have 5 years of that kind of pattern.
And one of the things also in that post, even breaking that down further in terms of kind of even the softest spot, maybe at the softest table, was you talked about institutions that we're in, or professional investors that we're in, and where they're focusing more, and still even finding kind of the quote-unquote fish, I guess, to take the total poker analogy, the fish still within crypto. You probably saw more opportunity, or you were staying away from ICOs. You saw more opportunity elsewhere. Do you still think that's the case? Are you still staying away from ICOs? And obviously disclose whatever you're able to.
Sure. Yeah. So at the time I wrote the article, I commented that I thought the pre-ICO space was more competitive than the exchange-listed space. In retrospect, I'm actually not sure that that was accurate. I definitely think it's accurate today, in the sense that right now there's a lot of capital chasing the handful of, if you think about how the ICO ecosystem works, you have early pre-ICO rounds that generally that are often sweetheart deals that go to big name investors, angel investors, the top name funds. And they're sweetheart deals in the sense that those are they're extremely likely to make money on those investments. And the project wants their brand. They want to be able to say that this big name person is an investor. And then there's a later stage pre-ICO round for smart money investors. And then eventually the project gets offered to kind of the average investor, either in an ICO or when it gets listed on exchange. And those people might still make money, but how can those people make money in a sustainable way? You almost need the project to fundamentally succeed. Like in trading, so in investing, you have actual value creation. So Bitcoin over time can go up, not forever, but almost forever as it goes from having 30 million owners to 300 million to 3 billion potentially. For trading, it's a little more zero sum. Right? If I'm selling something, someone has to be buying. And so what's happened in the last 6 months is that person who's buying the ICO on the exchange has mostly been losing money. And so the ICO buyer has mostly been losing money. The late stage pre-ICO buyer has mostly been losing money. So it's kind of like dominoes that we're seeing fall. And so right now, I would argue that there's actually a ton of capital. So you have some funds that have raised hundreds of millions of dollars to invest in pre-ICOs. Well, a pre-ICO project that's early stage doesn't need a fair valuation of that project might be $20 million. It's hard to deploy tons of capital for those early stage projects. And if you have a $300 million fund fighting to put as much money as they can into the very best early stage projects, what you see is they push out everyone else. So if it's actually a great project, you as a retail investor, you're just not going to get in. What you're going to be able to invest in are the projects that the big guys didn't want, right? You're going to get the scraps, and that's not a good setup. And then the other issue is that that big amount of capital in those early stage investments pushes up valuations, right? So if a project's trying to, if they think we think we should be valued at 20 million, we want to raise 10 million to 20 million valuation, and then a bunch of funds all say, hey, we need to write $5 million checks to you, that pushes up the valuation, pushes up the raise, and makes it a less attractive investment. So right now, I actually think the pre-ICO space is definitely not a great table to sit at. There will be people who make money at it. If you're exceptional at picking the top 1% of projects, you'll make money. Or if you're able to get access to the best 20% of projects early, you'll make money. My guess is that from current valuations, everyone else will probably lose, or will lose relative to the market. I mean, if the whole market goes up 5x, it's similar to late 2017. Kind of everything's up. You'll make money, right? Everyone can win if the whole market is up, but. In contrast, there's kind of no limit to how much capital something like Bitcoin can absorb. Like, if that $300 million fund wants to put it all into Bitcoin, they can pretty easily, and they won't move the price of Bitcoin that much. So at the moment, I think pre-ICOs are a tough table.
You brought up access at the end of that question, and I think it's something good to bring up, especially in terms of, because you also talked about projects will kind of want big names. Let's say they want BlockTower, they want Pantera, they want Polychain to invest in their pre-ICO, and retail investors maybe look at that and they say, okay, where's the quote-unquote smart money going? I think you or someone else in the space had a really smart post about this, and not a lot of people talk about it. Just because, maybe that name or that fund that you quote unquote think is smart money invested, they might have had access to a lower round. Do you think just because a Pantera or just because a insert any name here invested, do you think for a retail buyer that even matters, right? Does it matter that Pantera just invested in my ICO? They probably had way better access. They probably got it at a better price. Does it matter?
In practice, it certainly does. So there's the reason that a firm like Pantera gets the sweetheart deal is because the project knows that matters so much to retail investors. The fact that Pantera invested means the project is likely to have a successful ICO. So the question of should it matter, I think it should matter a little bit because the big name funds do their best to not invest in scams and to not invest in the worst projects. So it's a little bit of positive signaling that the project is probably not an outright scam. It's probably not bottom quartile or bottom half. Doesn't mean it's great. So almost any asset that has any value is a good investment at some price and a bad investment at another. There's a lot of ICOs that are bad investments at any price. Pantera is probably not investing in those. But there's a lot of projects that are great investments at the price that a Pantera is going to get in and are a terrible investment at the price that you as a retail investor are going to get in. So I think it's reasonable for the retail investor to take it as some signal, but not that powerful of one. Certainly, they should not blindly just be chasing. We see the same in traditional markets, just to a much smaller degree, where, Warren Buffett invests in a railroad. It's up 30% on the announcement. Should I invest? Well, 30% return is a big deal. Like the fact that Warren Buffett instantly got a 30% return, that made it a great investment for him already. The fact that you're investing 30% higher, the difference with ICOs is you're not investing 30% higher. You're often investing 300% higher. Pantera has already won by the time you're investing. Mm-hmm. Pantera doesn't need anything else I'm not trying to pick on Pantera. Right?
Yeah, it's just hypothetical names.
That early investor has already won by the time that project gets to your plate. They don't need it to go up. In fact, you could invest, it could fall 50%, and that early investor may still have earned 100% return in 3 months.
Mm-hmm. Okay, cool. Yeah, I want to break that down I know there's probably a good amount of you guys who are listening, and I've been seeing that in my messages as well, and people will often comment, look at a project and say, look, Pantera's made a play, or not to keep picking on Pantera, someone else made a play, I should be in this. So I think that's a really good concept in terms of access. Also looking at where, other institutions would be buying. I think the other kind of wave of misinformation that gets spread, whether it's across Twitter or elsewhere, is people will talk about, institutions are going to come in, whether it's the VCs, the risk-tolerant VCs, whether it's pensions, whether it's endowments, they're going to come in and they're going to buy my bags. Both in terms of liquidity and also kind of what makes sense there. What kind of coins can institutions even be buying, and where would the money flow first? Are they going on Bittrex, or are they mostly just looking at Bitcoin, Ethereum, maybe top 5, top 10?
So I mean, to be honest, this has surprised me a little bit. Indirectly, institutional money is going to some altcoin bags, very selectively though. So, for example, some institutions have invested in firms like Placeholder Capital, which is run by Joel Romanegro and Chris Bernisky, who are great guys, great investors. So they have institutional investors, and they publicly announced that one of the assets they were investing in was Decred. So Decred is an altcoin, trades on Bittrex. And that was a little surprising to a lot of people, myself included, because Chris and Joel are early stage investors and they're investing out of a VC fund. It makes total sense for them to look at both exchange listed assets and pre-ICOs because you have plenty of exchange listed cryptocurrencies that are seed stage investments. They're very early stage. Some of them are ERC-20 testnets, right? Or they don't even have a testnet yet. They just happen to be tradable. So it makes total sense for Placeholder to do that. A couple other, another VC fund, I believe, I'm pretty sure it was Bluebird Capital, said the same, that they were also investing in Decred. So a little bit, but I would not count on it. I think those VC funds that invest in exchange-listed assets, they're only going to be picking a very small number. It's going to be 2, 3, 4, 5 that end up attracting meaningful VC capital. Pensions and endowments are not going to have an account in Bittrex. They're just not. So the way that institutional money could flow to Bittrex is, or Bittrex coins, is through other investment funds and firms, crypto hedge funds, crypto VC firms. But the big way, and a small amount of money can be meaningful, right? So the big dollars, I'm very confident, or at least enough, if nothing changes in the next year, are going to flow to Bitcoin, and then to a lesser degree, the other Coinbase coins. A term I use a lot are the Coinbase coins, and the reason for that is they're not securities. So there's no regulatory issue with them being securities, which is a big concern for institutions. And Coinbase is just an easy fiat on-ramp. It's an easy way for family office or endowment to get access. And those tend to be the coins they've heard of and that they feel more comfortable with. So they tend to have less hair on them from a scammy or regulatory perspective. They tend to be a little more decentralized. You're gonna have a lot of index funds that launch with, I mean, so Coinbase itself is launching an index fund that represents ownership into its coins. So I think the big dollar amounts are gonna go to Bitcoin and the Coinbase coins, but you don't need, but like $1 billion to Bitcoin is like $1 million to some altcoins on Bittrex, so. But no, I mean, I think the moral is I wouldn't count on institutions bidding up Bittrex or Poloniex or Binance coins. Most of that institutional money is going to go to the Coinbase coins.
That's a group of coins that I've kind of coined the term. I call it pleb potential on Twitter. And you also have a thread recently in terms of concentrated ownership in coins. And it obviously makes sense that larger investors are only going to be able to go to Coinbase coins, both due to liquidity reasons and because, yes, they're probably the safest. I can't say that's not financial advice, but I would probably say that the safest, just looking from a bird's eye view. Can you break down what that even means in terms of concentrated ownership and how, let's say, like even a big retail investor or an institution wants to take an investment, maybe a smaller coin, and they have a meaningful position? What kind of problems does that pose all of a sudden, and maybe why couldn't they be investing in those smaller coins?
Yeah, I mean, liquidity is a huge issue. So a lot of the liquidity is fake, as we know, where, there have been all these stories about just how much of volume, particularly on Chinese and to a lesser degree Korean exchanges, was wash trading. This is very easy to see where you'll have a coin that's trading 5 million a day in liquidity, and if you try to sell $300,000 worth, you'll crash the price 30%. Yep. Which just makes no sense if that was real liquidity. So when I say that it's not real liquidity, it's not necessarily in any way criminal or market manipulation. So a lot of these coins are now using professional market makers who are not doing anything wrong. The way market making works generally is the market maker is providing bids and offers, and they're showing a tight bid-ask spread, which provides a very valuable service. So if you're a retail trader and you want to buy $5,000 of a coin, the market maker is making it much easier, right? They're providing you a tight market, they're giving you a good price. That market is probably liquid enough if you're a retail trader to quickly exit, to use a stop limit order. So the market maker is providing a really valuable service to the retail trader who wants to trade $5,000 or $10,000 worth. As the dollar amounts get bigger, though, that market maker basically wants to be flat. They want to have a flat position. They want to have no exposure probably every day. And so what happens is if there's meaningful net selling, the market maker's buying, but then the market maker becomes a seller very quickly, right? The market maker's like, oh man, now I'm long $50,000, $100,000, $500,000 of this coin. I don't want to just be riding this coin as it sells off. That's not my job. So they become sellers very quickly. So as a result, most coin, like here's a really simple rule of thumb. Currently, anything outside of the top 5 coins, maybe the top 10, realistically trying to do more than half of 1% of volume a day is you're probably going to really drastically move the market. Trying to do, so if you have a 1% position, so what does that mean? So let's say it's a coin that has a $50 million network value, right? A fairly, that's maybe right now the 60th biggest coin on CoinMarketCap. I may be off on that, I'm guessing. So that, a coin that's not a big coin, but not trivial, and maybe it looks like it's trading $5 million a day. But if you own 1% of that coin, that's $500,000, that's a big position. You're a whale. You're a whale in terms of how you're going to move the market. And that liquidity, even the 5 million, can go away so fast. So a very real concern for institution is, what if you have a coin that mostly trades on Bittrex and Bittrex delists the coin because they're afraid it's a security, or Bittrex faces regulatory problems? What happens to that coin's value? And my view is that for most of them, the project probably dies. So if it's a good project, if there's real economic value there, they'll get listed somewhere else. The project will survive. Temporarily, the price of the coin may fall 90% because it may only trade on a DEX. It may only trade on some tiny exchange. But the project will survive. And if you're a long-term investor, but most projects will not survive that. They won't survive complete loss of liquidity. And what you'll find is suddenly, you thought you had 20 grand of a coin, or if you're an institution, maybe you thought you had $1 million of a coin, and suddenly the thing has no value. Like, you just cannot trade it. Or it trades on a DEX and it looks like a fine price, but it's trading $10,000 a day and you have $500,000 worth. So liquidity really matters, and liquidity is a coward is kind of a classic line, right? That when you really care about liquidity is when you and everyone else want to sell, and that's when liquidity just vanishes. And in crypto, it can vanish even more aggressively, where the coin can just be listed.
Yep. That's in some ways it's reassuring, that post you made. Let's say I have a modest position in a coin during this bear market where volume is kind of dried up. In some ways it's reassuring because it makes the decision a little bit simpler, in the sense that I can't sell that position. At the same time, it also is kind of that thing in the back of your head of if this does continue, then there's just really nothing you could do. So it kind of ties your hands. Cool. So I want to drill down on that in terms of where they can get in. One more thing I want to unpackage kind of in your first response was, what kind of funds, just breaking apart one more time, the actual institutions that are in, and maybe what's still stopping them today. So you've been pretty open and probably one of the most transparent about your previous predictions in the space, or your previous kind of outlooks, and then which are correct and which are incorrect. And I watched a video, I think 6 or 7 months ago, and it was on, I don't know what network, but you talked about what family offices were in, what endowments were in, whether they're writing that first check, and then what pensions were in. Now that some hurdles are kind of getting cleared up in terms of custodial, and maybe regulatory is also cleared up a little bit, what are some of the hurdles that are going to keep maybe pensions or endowments, which are some of the last to get in? What are some of those that need to be cleared up? And also, how far along are we? Are pensions getting in, or is that still 6, 12 months out?
Yeah, so a super rough time frame. Something like, so the earliest crypto investors were cypherpunk anarchists, computer geeks, cryptographers. Then Ethereum ushered in this techno-utopian wave. People who were not anti-bank or anti-government necessarily, the people who believed in what dApps could do. A bit more of a sci-fi future, and that ushered in this whole venture capital wave of both the VC funds themselves, and also a lot of the money that came into cryptocurrency in, say, 2016 and early 2017. There was a lot of CTOs of tech companies, a lot of Silicon Valley kind of executives at firms, or engineers with some capital, or VC partners themselves with their personal money. Now we're getting kind of the Wall Street wave, where Goldman Sachs has launched a trading desk, and Fidelity is probably going to launch Bitcoin custody by year end. And you have a huge number of kind of new service providers, Bloomberg for crypto being created, every element. So here's one example. So right now, I think one of the obstacles is exchanges. So it's very, we talk about a Bittrex, a Poloniex. These are so amateurs from the perspective of a pension. It's a joke. It's a lot of these exchanges don't support institutional accounts. So this is actually an issue for Block Tower. There's a lot of exchanges where you register as an individual with your own personal name. That's a very weird idea if you're a regulated entity investing on behalf of other people. You know, they're not high frequency. They're not, a lot of them don't use fixed API. So I'm not an algo trader at all. So my understanding of this is very limited, but everything in the traditional financial world uses a particular format, a protocol called fixed API that allows for high frequency trading. Every exchange uses its own custom API. So a challenge that people face if they want to trade on a bunch of exchanges is you have to code a separate connection to every individual API. And forget about high frequency. A lot of exchanges will only allow you to do, say, 3 transactions per second, not the 1,000 per second that you're used to. So that limits things.
And they're constantly changing that as well, right? There's no standard. Let's say if I'm Bittrex or I'm Binance or I'm whoever, they're constantly kind of changing maybe their custom API setup. Is at least what I've seen.
Constantly changing, and the exchanges are down a lot. I mean, Binance has had a ton of issues in the last 48 hours, for example, where they've been up and down several times. They've you've had to recreate API keys. They're limiting withdrawals. All of that is just totally foreign to the traditional. Like the idea that as a family office or pension, it's, oh, we can't take our money off Binance, we don't know when we'll be able to, and we can't get someone on the phone, is a non-starter. That's just not professional, right? And I'm not trying to pick on Binance, that's just the state of the crypto industry. And that's changing though. So there's a ton of upcoming exchanges that are run by people who, I think it was not CME Clearport. I'm trying to remember. There's a gentleman who ran one of the biggest exchanges 10 years ago. I don't remember if it was the NYSE or he had a clearing firm. I think it was CME Clearport. He's one of many from traditional Wall Street who have a lot of credibility running professional exchanges who are launching crypto exchanges. It's a long process. They need to get regulatory approval. But that's one of the building blocks. We talked about custody a bit. That's a big obstacle. Yep. One element of it, a little bit, is regulatory clarity. So a lot of these institutions, like a pension, they're concerned that they don't know what they don't know, and they don't know what might be illegal. So, for example, if Ethereum was deemed a security, so this is kind of weird. It's reasonable for anyone to currently say we're pretty sure Ethereum is not a security, but we actually really don't know. So the SEC does not have authority to declare things securities or not. That's actually not up to them. What the SEC, the way this works is the Supreme Court issued a ruling, the Howey test, and that Supreme Court ruling, in conjunction with congressional law, determines what is or is not a security. The SEC has jurisdiction over things that are securities, and they can pass rules relating to those. The SEC can't decide if something is or is not a security. That will actually have to be tested in court. So what could happen is a different governing body could say, no, Ethereum is a security. And then that would go to a court where potentially the SEC and this other body might be fighting. And maybe it's FinCEN, maybe it's, and the SEC has not actually issued a ruling. They had a gentleman give a talk, and they posted that talk on their website. It's not an official statement. It's not a no action letter. So, and if Ethereum is a security, there's all sorts of rules relating to who's allowed to own it, trade, and transfer it. So if you're a pension, you're very scared that maybe you buy Ethereum and then maybe the SEC changes their tune and you're not allowed to resell it.
Yep.
So there's a lot of, there's still some genuine uncertainty about the regulation around the space that is concerning. Some of it is still lack of knowledge or lack of understanding. So I had a conversation with an investor recently who said, hey, when I invest in a long-short equity fund or a global macro fund, I can look at their portfolio and understand roughly what's going on. So, if they tell me they're overweight materials and underweight consumer staples, or if they tell me they're going long the yen and short the Aussie dollar on this thesis, it's not that I can tell if they're right, but I at least I know what they're talking about. If you talk to a crypto investor and they say, yeah, I'm long, Decred, and because I like the proof of stake, proof of work hybrid, and I like their work on their governance mechanism, or I like the staking rewards, that investor probably says, I have no idea what any of the words that just came out of your mouth were. And get to the level where you can intelligently discuss, is proof of stake, proof of work hybrid good, and if so, why? That's pretty advanced, right? It takes a lot of time. It's been amazing in the last year. A year ago when I would talk to pension investors, it was, what is a blockchain? what is a Bitcoin? Or, oh, wait, there are other coins beyond Bitcoin? I thought Bitcoin was one, right? That was a year ago. Now they all know what Bitcoin, now they can all name 5 coins or 10 coins. They all have heard of proof of stake. Some of them have even heard of sharding and have a rough idea that it's a scaling method. But that's after like a year of work, right? It takes, I think we sometimes take for granted, cryptocurrency is so new. There's so many basic concepts that take time to socialize, take time to get comfortable with, that to us, even if there are a lot of people in the world, in the crypto world, who even if they can't define, or even if they don't really understand a concept like sharding, they've at least heard of it. They at least have some sense of comfort. Like, okay, I know sharding is scaling for Ethereum, or is, whereas those terms are just so foreign, and a pension fund manager is going to want to, like, this is how this works in practice. The person at the pension who's going to underwrite the investment is going to get quizzed on it by their boss. And they need to feel that they have a level of expertise that they can answer standard questions for 2 minutes. And so, but you're, that pension manager says, oh, we just invested in this index fund that owns 10 assets. And the CIO or the committee says, oh, give me 2 sentences on each asset. Give me 2 sentences on IOTA. Give me 2 sentences on Ripple. And the person gives 2 sentences on Ripple and says, oh, well, it's delegated proof of stake. There's the Ripple company behind it, but the token may be decentralized, may take on remittances in Swift. And the person says, oh, well, what's delegated proof of stake? Give me 4 sentences on that, right? So it's very hard for someone who's kind of a mid-level manager or a managing director or portfolio manager at one of these institutions to invest in cryptocurrency, because everything is so foreign to them. Whereas even if they're not an expert on corporate bond investing, they have an MBA or they have a master's in economics, and they know what bonds are, and they can talk about yield versus, yield correlation equities for 2 minutes.
Yep. So all those concerns are completely legitimate, and I hope that makes sense for everyone listening in terms of definitely still some of the hurdles, even if they do seem cleared up. When you see a headline on Twitter, you see a headline on Bloomberg, there is still that hurdle there. I think one of the simpler hurdles in kind of pivoting to away from risks more in terms of benefits of why an institution would want to get in, one of the things, whether you're a retail buyer, whether you're an institution, and Ari, I'm sure you've seen this, is people getting in, and I think you actually talked about this at Consensus Invest, people getting in will look at it, and I've had meetings with people that I used to work with and different family offices, and they'll look at it and they'll say, look, it's so volatile, it doesn't make sense, it's too risky. Can you kind of talk about why looking at an asset by itself in isolation maybe doesn't make sense for institutions that are looking to add this in a small percentage in their portfolio? Why it would potentially be beneficial in terms of actually reducing their risk? How could adding the riskiest asset, at least historically, potentially lower your risk going forward? Why would an institution want to get in?
Yeah, to be frank, this frustrates the heck out of me because, so my title at UChicago, I was portfolio manager and risk manager, and I take risk very seriously, and I'm very honest about the risks of investing in cryptocurrency. What frustrates me is it's a admission usually by the professional investor that they're putting their career above the interest of who they're supposed to have the fiduciary obligation to. So. And I'll explain that. So there's a lot of professional investors, wealth managers, endowment investors who personally own cryptocurrency, but will say it's inappropriate for their institution. And what they're really saying with that is, so anyone who understands risk in the financial concept, anyone who has an MBA or CFA designation, anyone who works in a risk management team should have a full understanding of this basic idea, which is you only care about marginal risk. So I'll explain what that means. So in 1920, there was a belief that it was irresponsible for most people to own equities at all because equities are risky, equities are volatile. You should only be in blue chip corporate bonds. That's safe. And if you were a wealth manager and you put your investor, let's say you put $1 of your investor's money in any stock or in a corporate bond of a riskier enterprise, you would be on the, and they lost money, you would be on the witness stand and the judge would say, why did you think that that investment was safe? Mm-hmm. Today, we recognize that's nonsense. If you invest in the S&P 500 index, where you own a basket of 500 stocks, you're not saying that every individual stock is safe. What you're saying is that as a whole, that basket of 500 stocks looks attractive, and that maybe there's a really, really risky company in that 500, but I only have 20 basis points of my money in that one company. And so a basic idea of risk is there's 2 types of risk at a very high level within a portfolio. There's systematic risk, which means risk that contributes to the risk of the total portfolio because it's correlated to the market. And there's idiosyncratic risk, which is the risk of that company or that asset that has nothing to do with the market. So as a simple example, There's some companies that are very, very tied to the general economy. So a crude oil driller, for example, tends to be basically, if the economy is doing well, usually demand for oil goes up. If the economy is doing badly, it goes down. There's not that big of a difference between crude oil drillers. They're all doing pretty similar things. It's hard for them to separate from the pack. And so most of the risk of owning crude oil drillers is basically price exposure to crude oil and the market as a whole. In contrast, a company like, would be a good example here. A company like Tesla probably has a lot of idiosyncratic risk. It's a bet on, will Elon Musk and his team succeed at what they're trying to do, and will Tesla succeed relative to their competitors? So it matters. If the economy as a whole does well, there are going to be more cars that are sold. If it does poorly, fewer cars. But probably with Tesla, you're betting more on Tesla versus their competitors than on all car companies put together. I don't know if that's the best example, but so in cryptocurrency, what we've seen recently is there's very little diversification benefit. There's been very little idiosyncratic risk in practice. Most of your risk as a cryptocurrency owner is market risk, is the risk of the cryptocurrency market as a whole. Everything went up, everything went down together. I'm oversimplifying, but now cryptocurrency has been almost uncorrelated to stocks, bonds, and gold. I'm not saying for sure that'll continue, but it's a pretty good bet that cryptocurrency will remain less correlated with stocks than other stocks are, or less correlated with stocks than bonds are. So it's not saying the correlation will be zero, but if correlation is less than 70%, you get a wonderful diversification benefit. So I'll put concrete numbers to it, or frame it directly. If you take 5% of your assets in a typical endowment portfolio or diversified portfolio, well, I'll take a step back. If you have a portfolio of equity, bonds, real estate, commodities, most of your risk, you're very highly correlated to the general global economy and to the basically US and global equities as a whole. So even your real estate, even your bonds are pretty highly correlated to public equities. If you take 5% of that exposure and you shift it to a coin, to flipping a coin, if it lands on heads, you double your money. If it lands on tails, you lose your money. That's a very risky bet. It's a coin flip. But because it's uncorrelated, because it has nothing to do with the rest of your portfolio, it actually reduces your overall risk. Yep. Now with cryptocurrency, it's kind of like that coin, but we hope that instead of being 50-50, that there's this positive expected value. So cryptocurrency is a very, very risky bet, good chance of going to zero, but positive expected value. Because it's uncorrelated, it's all idiosyncratic risk relative to the rest of your portfolio. So your risk falls and your expected return rises, which makes it the holy grail of investing. So endowments, pensions should be drooling over cryptocurrency because it's literally, as a portfolio manager, what you're desperate for. You're desperate for a source of uncorrelated returns and uncorrelated risks.
That's just, it's for someone outside of finance or someone new to investing, that's one of the things that they'll trip up on and maybe not even dive deep and understand. But that's one of the things, and you said you were frustrated. It's frustrating for me to even talking to my friends and retail or other people, and I don't ever really advocate or try to sell anyone to get into crypto, but it's one of those things where institutions, I know that's probably still a hurdle, or just general people, I know it's still a hurdle. So wanted to break that down too. One more thing to talk about now that we've gone over risks and benefits of institutions possibly getting in is kind of the one last thing. I know some institutions are in, whether they're hedge funds and are market neutral or they're VC funds that are more long-term. There's been a few catalysts that have kind of at least made retail think more institutions are getting in. And a few of those have been kind of CME or futures markets opening, which were legitimizing the space in some ways. The next catalyst that everyone seems to be looking for is ETFs. Can you kind of talk about what would be the difference of an ETF being approved? What would be the difference of a fund having to, or dealers having to stock up an inventory as opposed to just having derivative exposure? How would that be beneficial? Would that get more institutions in? Would that be a massive boom for institutions?
Yes, I think an ETF approval would be massively bullish, massively. There are a couple of ETF proposals in front of the SEC right now. As a super rough guess, and it's just a guess, I put the odds of approval in the next 3 months at 1 in 4. I don't think anyone knows, and so that's literally just a guess. That's not based on very much. ETFs that are based on Bitcoin futures are more likely to be approved than ETFs based on Bitcoin, and the reason for that is the futures are regulated, CME and CBOE. They're monitored, they're transparent, and they've been successful so far. Successful in the sense that there haven't been any big failures. The futures have worked as advertised. So having an ETF where the underlying is something that is closely regulated and on traditional exchanges makes it easier for the SEC to approve. I don't have an answer. Your question about like basically do dealers need to stock up on inventory for the ETF? Frankly, I don't know.
Or does that bring more money in if it is an ETF based on underlying versus an ETF based on derivatives? Would kind of the same thing?
I don't think that distinction matters. The reason being, whenever you buy a Bitcoin future, on average, someone is buying a Bitcoin. So you buy the Bitcoin future, you're buying it from a market maker. The market maker
who's
sells
also
you
hedging,
arbitrage, and they hedge by buying a Bitcoin underlying. There can be edge cases where that's not true, but no, I think it's basically one-to-one. So if someone buys whatever it is, $6,600 worth of ETF, some market maker is selling that to them. They buy the futures, that then gets transmitted into the underlying. So I think it all works its way to the underlying, at least most of the time. You would have some dealer inventories, but mostly it would just be the amount of money that goes into the ETF would be transmitted to the underlying. But I think it would be a lot. So not instantly, but yeah, on the announcement of the ETF, I would personally think the fair value of Bitcoin should shoot up by 50% at least. I think it's that bullish. That's on the announcement. And then over time, it should produce a persistent bullish effect.
Yep, that's fair. Cool, very interesting. That's all I really have. I think that covers, in terms of who's in, what's kind of stopping other people from getting in, risks, benefits associated with all that, and then kind of catalysts also looking ahead. Hopefully you guys learned something from this. If you want to, check out the audio version down below on iTunes, SoundCloud. I'm also on Twitch. I'm also going to have links to Ari's page and any other resources that we maybe referenced down below, maybe some of those blog posts. Ari, thank you so much for coming on. What's next for you? I know you've kind of been trying to formulate maybe some new big ideas in the space, or kind of staying away from posting as much content. What are you working on now? What's kind of next on your agenda? What's exciting for you in crypto?
So there's a handful of really important questions that I've been struggling with for a year that matter a lot. And frankly, a challenge for me is kind of finding the time to do fundamental deep dives at this point, trying to manage a firm and juggle day to day. And so one of those really important questions is consensus mechanisms: proof of work versus proof of stake versus proof of space time versus proof of elapsed time. There's a lot of consensus, like what is really going to determine the winning cryptocurrencies? There's only a few things I think that really matter. So, a common discussion point when we talk about can something overcome Ethereum is, well, can Ethereum just incorporate any new feature? So, okay, Zcash is ZK Snarks, Ethereum can add ZK Snarks, and they are. Ethereum is potentially going to add something that is very similar to Filecoin with Swarm. And this is true of all cryptocurrencies. So Blockstream just announced that they were going to add something very similar. So on Ethereum, there's a lot of work to allow for the issuance of real world assets using Polymath or Harbor. Stellar and Ripple have that ability using anchors to issue real world assets on those chains. And now Bitcoin's going to be able to as well. Blockstream announced that they're adding that feature via a sidechain. I don't know if it will work, but the point is that almost any feature that any protocol can do, you're going to be able to do on any other protocol in 5 years, or maybe much sooner. So what determines winners? Well, there's only a couple things, I think. One is the consensus mechanism. So if proof of stake is actually much, much, much better than proof of work in all regards, if it's equally secure but much cheaper, that potentially displaces Bitcoin. And trying to understand that is really, it's fascinating and it's very, very complex, because I give you here's the really quick summary of my current view on proof of work and proof of stake, and I'm trying to dive much deeper. They both have a whole bunch of game theory attack vectors, and they're different. And so it's hard to directly compare them. So yes, there's a lot of problems with proof of stake. There are ways that can be taken advantage of. The same is true of proof of work. So something like a proof of work, proof of stake hybrid may be interesting, and or maybe not. So does that hybrid actually give you the best of both worlds or the worst of both worlds? So I think these are really important questions that have not been driving the market. So one of the reasons I didn't dive deeply into them 6 months ago was because I thought the market is not going to know the answer to these questions for a while, and this is not what's going to drive price. But we're getting to the point where it will drive price, because Ethereum is talking about hard forking to get proof of stake very soon, maybe in the next 4 months. I don't know if that's actually going to happen, but Vitalik has indicated it's on the table. And so suddenly owning Ethereum is likely to become a bet on proof of stake. And I hope to have the right answer before the market does, or before reality shows us. And at the moment, I do not. I do not have the right answer to that. So, and one extension of that, even a higher level, trying to understand in 10 years, is this going to be a world where there's one winning cryptocurrency, or where there's 1,000? Is there going to be a world where there's a few giant winners like Facebook and Amazon, and then a bunch of medium-sized companies? The answer to that partly depends on which consensus mechanisms work. For example, with proof of work, there can only be a couple secure chains in the entire world, because proof of work, the security scales linearly with hash power, at least the current versions. What that means is a proof of work protocol that is small is fundamentally insecure. And a fundamentally insecure protocol might be fine for a lot of use cases. You don't need $1 billion of security for a card game, or for a simple Pokemon or digital collectibles that don't have that much value. But in a proof of work world, we probably don't have 10 giant chains. There's probably 1 or 2. In a proof of capacity world, well, proof of capacity probably is the same, but there might be consensus mechanisms that support many, many smaller secure chains. It's a really important question to even have a high level view of what we're investing in, what this industry is going to look like. To me, are still unanswered questions.
Yep. Tons of, I actually just dove into Laura Shin's podcast where she had Joel Monegro on, and he talked about why Decred was that first public investment that you mentioned earlier. That was a surprise to some people, but they were looking at kind of that hybrid and whether it does make sense. And I think whether you're listening to this, whether you kind of ascribe to proof of work and it's going to be a winner take all, or you ascribe to maybe hybrid and there can be, you know, all these blockchains doing different things, I think it's important to kind of understand that no one knows. There's a lot of unanswered questions, and to kind of place your bets based on those and hedge your bets if you think it's necessary. But anyways, Ari, thank you so much for coming on. Before we dive into that, thank everyone for watching as well. Ari, do you have any closing thoughts? Anything else you want to say?
No, I think I spoke enough.
All right, good stuff. Thanks for coming on. This was fun. Hopefully you guys learned something about institutions and institutional money coming in. You can stop asking the when institutional money meme on Twitter buying my bags. I just don't think it's going to happen, guys. Think about this rationally. Rewatch this if you need to. Thanks for tuning in. I'll see you guys next time. Thanks, Ari.
Thank you.